During a typical bull run, two things happen. Existing investors pump in money into the market and take the markets up higher and higher, and also by seeing this, new investors come into the market hoping to get some of that crazy profit. So once this euphoria happens, that means everyone is happy that the market is moving up and everyone believes that it will continue moving up. This is when the market crash usually happens. So who all get trapped in this? The older investors who had very low averages during the start of the bull run but kept on buying and their averages increased up, and also the new investors who had no other option than to buy at the peak level of prices. So this is where the importance of building a profitable portfolio comes in, and that is exactly what we'll be discussing in this video. The name is Ajay Ajit. Welcome to Market Feed. So you might have heard the term which is diversification across multiple YouTube videos or across your favorite books as well. What does this mean? This means that bringing in a balance to your portfolio, diversifying it in a well enough way that even through the ups and downs of the market, you will be shielded through all of it. So this will ensure that when the market is moving up, your entire portfolio will move up along with it. But when the market has some tough phases, when it is downtrending or it is in a consolidating mood, then also your risk in that portfolio will be contained to a certain level. So diversification means that you have some non-correlating assets in your portfolio. What does that mean? Usually when the market is moving up, let's say you've invested in the Nifty 50. When the Nifty 50 is moving up, if you have spread out your investments into large caps, small caps and even mid caps, the Nifty 50 will usually move along with the small caps and mid caps as well. And whenever the Nifty 50 falls, there is a high chance for the small caps and mid caps to fall along with it. So does this mean it's a diversified portfolio? No, it is not. There is a correlation between all of the different assets or funds that you have invested in. Now let's compare this to a Nifty G-Sec fund which invests in top government security bonds, right? And this, when you're looking at the chart, you can see that whenever Nifty rises, the G-Sec also gives a similar move, or it might even tend to move oppositely. But when the market actually falls back down, this G-Sec has a tendency to move back up. What does this mean? This means simply that they are non-correlated assets, and if you invest into both of these at the same time, you can say that you have a diversified portfolio. So now the question comes, how much should you diversify? The market is moving up, it's moving down. Where should you invest and how much should you diversify? So the question comes when tricky parts of the market come in, right? When the market is moving up and up, everyone wants to be in on equities, but when the market starts to trend down, that is when everyone wants to learn about diversification. So let me tell you this one thing. How do you assess the risk of how much should you be investing in debt securities versus equity? So always there is this general concept that you should be having 100 minus your age should be invested in equity and the rest should be invested in debt. So what does this mean? This means that if you're a 20-year-old person, you should be investing 80% of your investments into equity and the rest 20% into bonds. So I would say that's a very basic way of looking at it, but if you're part of this community, you can take it to the next level. So the things that you have to consider are age, your tenure of your goal, how long you have set your goals for, then your type of goal. Then you would also have to look into your personal risk profile and your number of dependents as well. So all of this coming together will help you understand how much you should be investing into equity and how much you should be investing into debt and bonds. So I could give you an example of my personal journey as well. There are a lot of factors depending on where you are in your life, your age, as well as your investment capacity and your spending ability as well. So let's look at this example. When I was not earning that much, I was more of a risky person, right? So I would invest most of my savings, whatever I had, into equity. But as in a medium period of my life, I started to understand, hey, the market moves up and down. I shouldn't be doing this. I should be looking at a position where I have enough debt securities, enough liquidity in my portfolio as well. So I started adding more debt securities and gold into my portfolio as well. And after a period, I understood that my corpus had grown large enough that I was happy with it, and I could suddenly start to increase my risk exposure exposure by quite a bit more each and every single month. So do you understand what is happening? This means it is not just about 100 minus your age. You also have to look at a lot of other factors, including your personal risk-taking capacity when you're deciding to build your portfolio. But one general advice I would give you, do not try to invest 100% of your funds into just equity. This means that even if it's for a retirement goal, whenever you want to redeem that equity portfolio, you might get into trouble if the market has actually fallen. You'll truly be stuck in the market volatility forever and ever. So do not try to invest 100% of your long-term goals into just equity mutual funds. So after talking about risk management, next we'll also get into how much I've personally invested into equity, bonds and gold as well. This is something that you can have as a great takeaway from this video. So what I typically use nowadays is an 80-20 rule. It does not match with my age. It's not based on the 100 minus my age rule, but it gives me enough satisfaction that I have some money left aside for emergency purposes and for stability in my portfolio as well, along with the equity component which is giving me long-term growth. So 80% is invested into equity and 10% is invested into government securities and bonds, and the rest 10% is invested into gold. I also dip into this extra 20% when I'm in need of extra liquidity in the market. That means if Nifty corrects by 10% tomorrow, I have a decent allocation left in my debt and gold portfolio that I can transfer this back into my equity mutual funds. So I've kept it as it is unless there is a big market crash which is loading. So whenever there is a market crash, I'm ready to add in funds as well into the market. So when I'm talking about these three components, the things that I've invested into, in the 80% equity component, it's very simple. I've invested into Nifty Bs as well as Junior Bs. These cover most of India's top 100 stocks and you'll be very happy with investing in this. Trust me. In the next debt component, I've invested a considerable amount of money into gilt funds. These are government securities funds. You can find everything you need to know about them in my previous pledging video. And in the next segment, which is gold, I've invested into SGB as well. So the benefit of my portfolio, the way I've designed it is that all of these funds are pledgeable. All of them can be pledged and traded. You can get the margin. You can find out all about them in the pledging video that I've linked here. So this is all about my long-term portfolio. I've also kept a small amount of money aside for my swing and short-term investments as well. So here what I do is, for my short-term investments, that is 6 months to 1 year, I depend on what is known as a can slim strategy. If you don't know what it is about, do let me know in the comments down below and we'll make a video about that too. And I'm also an active swing trader in the market, and we also discuss some stocks here and there in the live show which are good opportunities for the short term. But otherwise, I've kept my mutual fund picking journey very simple. I've invested into very minimal funds. If not the Nifty Bs and Junior Bs, there are some certain funds which we have discussed in a previous video as well that I've invested considerably lesser amounts into. The larger chunk definitely goes into Nifty Bs and Junior Bs. And when we're talking about portfolio balancing and reviewing, I do not believe in booking profits and then reinvesting that money into the other asset. So what will happen over the course of the long term is, let's say you have built your portfolio in an 80-20 rule, and what happens when the market starts rallying? This 80 will turn into a 90 and your debt component will be reduced in your portfolio, right? It will become a 90-10 portfolio. It will become more and more risky or more and more volatile for you. Do you want that to happen? If you do not want that to happen, the general market consensus is that you start selling your equity component and then start adding whatever debt component is there. So the practice that I do or look into is that whenever you have to sell your equity component, there will be taxes involved. I do not want to get into that. There will be taxes, there will be charges. I do not want to get into that. So as far as possible, I try to increase my debt components in months where the market is actually rallying. Do you understand? That means you do not try to go and average out your winners, which is against the long-term thinking, but it helps diversify your portfolio and keep the volatility in check. And eventually, your portfolio will get back into the 80-20 rule, which you have set for yourself. In my case, it's an 80-10-10, as we talked about earlier. So we have discussed the current portfolio allocation from my end, depending on my age and risk factors. But according to you, more so importantly, according to you, according to all the factors that we discussed about earlier, you should be thinking about increasing your debt component into into a way which is more sustainable. But I would say try to keep it at a minimum of 80% equity and 20% debt and gold. Do not try to go above this 80-20 rule. Hope you have gotten into portfolio rebalancing and some thoughts about that as well. So if that's the case, get subscribed because we'll see you in another video very soon.